Hi guys, I'm Sophie. Today I'm going to be talking about the risk of investing in companies. This is important to know because you should know what you're getting yourself into when you invest. You could potentially lose some or even all of the money. Remember, all investments carry a degree of risk, and some are riskier than others. Your risk tolerance. This is your ability to deal with a swing in value in your portfolio over time. Think, in the worst case scenario, you lose all your money in a risky stock. How would you feel? What would you do? Before investing, you should evaluate your risk tolerance and only choose stocks that are within your comfort zone. Generally, there are 4 categories of investors when evaluating risk tolerance: conservative, cautious, balanced, and high risk. Conservative investors don't want a lot of risk and are generally happier with a lower return. They tend to invest in savings accounts or bonds, as both of those carry low risk. The next type of investors are the cautious investors. They are more willing to take risks and usually have a mix of assets. They may invest in shares, bonds, and savings accounts. Balanced investors accept risks much better and want to put money in shares and make more money rather than invest in a low interest account. High-risk investors, however, are willing to accept more risk in exchange for a potentially higher return. They usually invest in riskier markets and alternative riskier assets. Which type of investor would you want to be? Market volatility is what makes share prices in a company go up or down. The price of shares can go up or down through direct impact and indirect impact. Direct impact is something like the company launching a new product or service, the earnings go up, or a product recall. Indirect impact is something that is not really related to the company but still affects it. For example, a key opinion leader says that the brand is good, so many people want to buy the shares, so the prices go up. Or the owner or management of the company gets into a scandal. That may cause the stock price to go down. These are some things you should consider when you're choosing an investment that fits your risk tolerance. First of all, what is your investment goal? Maybe you want to save up money to go to college or buy a car. If you do want to save up for something, you shouldn't invest all your money in the stock market, but instead put some aside for those goals. You should also have some cold cash to invest. Cold cash is money that if you lose it, it wouldn't affect your life very much. Another thing you should consider is the time frame that you have to invest. If you start young, like when you're a teen, you would have more time to invest than if you started when you were 50. You should also consider your future earning abilities. You should only invest what you are sure you can make back if you lose it all. So you have to consider how much money you can make in the future. How can you reduce risk when you're investing? Firstly, you should do your homework and research on the company. You should look at the company's annual report, which is a report that contains the company's sales, their expansion plan, and what new products they plan to launch. However, as a teen, I find it very hard to read these as they contain a lot of information. So instead, you can watch the latest investor presentation. You should also get all of this information from credible sources and try to avoid fake websites and news. Investing in multiple companies instead of just one company also helps reduce the risk. For example, if you had invested all your money in one company and it went bankrupt or had fraud, then you wouldn't have any money left. But if you invested in perhaps, say, 10 companies and 2 of them went bankrupt, you would still have some money instead of none. As the saying goes, don't put all your eggs in one basket. So, before you decide on which companies you want to invest in, consider your risk tolerance, your life situation, and do research on that company. As Peter Lynch once said, Know what you own and know why you own it. That is one of the best ways to reduce risk. Thank you for watching, guys. Stay tuned for my next video about my own personal stocks in the first quarter of 2021. Please follow me on my YouTube channel and Insta at The Sleepy Gray Cat. Bye!